Monday, December 20th, 2021, Monaco 64, home of alternative economics and contrarian views. So some of you asked about the Christmas decorations. So Billy and I decided to do the video from the living room today. So you could see what we've got up, Christmas tree, some lights, and Billy's over there on his little sofa. So yes, it looks like the stock markets are continuing to crash. Kind of correct, really. It's not really a crash, even though 500 points used to be quite a bit in the old days. So gold and silver are actually holding on relatively well. Gold has been trading above and below 1800, but not really doing that much, holding on quite steadily. Silver is down a little bit, but not that much, really. Of course, a lot could change once the US markets come in a few hours. It is 8:30 a.m. London time. So on Friday, of course, the Dow finished down over 500 points. S&P finished down about 48 or 1%. And the NASDAQ actually finished virtually unchanged. It was only down 10 points. So what is going on here? As many of you know, I don't watch the mainstream business news or any kind of news, really. Sometimes I see people tweeting about it on Twitter, clips. But I can bet that today, if we stay as we are with weakness in the stock market, they're all going to focus on, you know what, something that starts with an O, and not maybe on the fact that the Fed maybe made a huge mistake by saying they're going to tighten, that they're going to do QE, that they're going to taper QE. I'm so used to them doing QE, sorry about that, that they're going to raise rates 3 times next year. Maybe that's what the markets are trying to tell the Fed. You do that and, you know, you just talk about that and this is what happens, right? So who knows? Be as it may, though, the system is really up to here in debt. We've also seen that a Democrat senator mentioned said he's going to oppose the Build Back Better plan from President Biden. It's a no-go. So that could be hurting things as well. Does that mean that we're not going to have inflation anymore just because they're not going to get 1.75 trillion through, even though they've gotten like 5 trillion earlier this year? It's not going to stop anything. We've seen Congress, both sides of the aisle, inflate, borrow, spend, deficit spend for over 50 years. And to say that it's only the Democrats, and I'm not a Democrat or a Republican or conservative or labor, I'm apolitical, but to say that it's only the Democrats that create the debt and deficit spend is it's a bit dishonest, because actually it was under Clinton, Bill Clinton, that finances got pretty much in order. They supposedly did run a surplus. I think it wasn't a real surplus, but there was a very small deficit, I have to say. And that's what the economies of the world, of the major Western worlds, are running on. They're running on deficit fumes. It's not the private sector. So yes, the excuse is going to be the old thing, or Omicron. I can say it. I don't think they have a problem with that. But so it will be a short one this morning. So we'll look at the markets now, see what they're doing. And one thing I would say, there's a kind of a debate going on my live stream. Someone asked yesterday, what do you think about Jeff Snyder? To be honest, I've heard of him. I might have read his stuff years ago. And apparently he thinks we are in a deflation, that the economy is deflating. I agree with him that the economy, if you strip out government spending, the GDP would probably be, well, not probably, but it would be negative. But we can't deny that we don't have rising prices, that we can't deny that we don't have monetary inflation. I mean, just look at the M1 and M2 chart. Google M1, M2 from Fred and have a look. I've attached those charts many times to my videos in the last few months. I'm not going to do it again because I'm tired of showing a hockey stick. But yeah, just have a look at that. Yes, maybe what he should be saying is that the economy is stagnant, but prices are rising and they're going to continue to rise even if the Fed is able to unwind the balance sheet, start raising rates. It's going to get even worse. And as I said in my live stream yesterday, yes, we could see a collapse of financial assets, but all the things we need to live on, all the basic necessities, the hard assets, they're going to go stratospherically up in value. The currency is going to go down against them. The dollar is a debt instrument. And believe me, governments and the central banks, they're going to do as much as possible to keep inflating. And they can. The Federal Reserve can create reserves out of thin air. And as Alan Greenspan said, the U.S. government can just print the money and borrow the money. The Fed will buy it through more QE eventually, indirectly, or maybe even directly this time. So, enough of my talking here. Let's look at the markets and then sign off for the day. 8:32 a.m. London. We've got spot gold basically unchanged right now at 17.98. Earlier on, it got up to 18.0450. The low has been 17.97. As I said, short-term moves shouldn't worry you. The long-term goal is to keep stacking, and gold and silver as well. Always act as insurance. You just have to look at the charts of gold in the currencies that have collapsed in the last 10 years and are collapsing right now, like the Turkish lira. Yes, they've done badly against the dollar too, but gold has been a good thing to have in those countries too, like Lebanon and Zimbabwe and Venezuela, right? So if the dollar is going to go the way of the Turkish lira and all the other major fiat currencies, there won't be a fiat currency that will save you. There will be the money of kings and the money of gentlemen, i.e. gold and silver respectively. So silver, as I said, is down a little bit, but only about 7 cents or 1/3%. 22.27, high's been 22.46, low is 22.2680. So we are near the lows. Right now, the Dow future is down 1.3% at 34,913. It's down 450. It has been down as much as 550. The NASDAQ 100 future is down 1.3%, and the S&P 500 future is down 1.3 as well. So weakness across the indices. Sometimes you get the Dow dropping and the NASDAQ going up. Today, all three are down. The FTSE is down 1.7% at 71.45. To the currencies, sterling is down 0.2%, just above 132, 132.07. The euro is up 0.2%, 112.60. The dollar is down 0.2 versus the yen, 113.53. And the dollar is unchanged versus its Chinese counterpart at 638.76. Aussie dollar is down 1/3 at 70.98. The dollar is up 0.15% versus the Canadian dollar at 129.14. And the Kiwi dollar is down 1/3 at 67.14. Moving on to the commodities. They're getting hit substantially here this morning. We've got WTI crude down 3.7% or $2.60 at 68.10. We've got copper down 1.33% at 423.85. And US natural gas is up 2% at 373. And to finish off, we're going to look at the manipulated 10-year yield. That's down 2.5 basis points at 1.38%. So the analogy for the bond market, I would say, especially the treasury market, is, for example, some of you might be golfers or not, but I'll use that because I'm a golfer. Let's say the people who run the rules of golf, the USGA and the R&A here in the UK, decided to make the golf hole twice the size. But some traditionalist golf clubs and golf courses decided to keep it theirs the same size as it's always been, because making the hole a lot bigger would make the game a lot easier and it wouldn't be the same. But as the ruling bodies decide to double the size of the hole, you wouldn't see the professionals or the top amateurs play in the old traditional courses because they wouldn't be recognized. And then you'd have all these tournaments played where the holes are really big and the scores would be completely different. You'd see professionals breaking 60 for 18 holes regularly, and people would say, wow, aren't these players so much better today? They break 60 every time they go out there. And then you have this kind of situation for 10, 15 years, and people forget that the old professionals and amateurs used to play with a hole half the size, and that's why their scores were higher, not because they were better. And it's the same thing with the bond market. The Fed and the other central banks for the last 15 years almost, or even more, because Ben Bernanke basically in 2002 with his speech said that they would make sure that their rates would always stay low through their helicopter QE. So that's why the bond markets look so artificial, even though we've got prices rising at really probably 15%, and we've got the 10-year yield below 1.5%, and that's why it's not real. Anyway, with that, I'm going to say goodbye to you. Before that, I'm going to say, if you enjoyed this video, of course, make sure you hit the like button. Make sure you share it far and wide. Make sure you subscribe to my channel if you haven't yet, and you like my channel so you get notified of all my new videos. And yes, you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.